Welcome to this edition of Security and Compliance Weekly. Those that are watching the show might notice a change of venue for me. More on that later. We're talking today to Steve Lenderman, Director of Strategic Fraud Prevention at ADP. Steve is going to talk to us about synthetic identities and entities, what you may know as deepfakes, and the threats they pose in numerous industries in the pandemic and post-pandemic world. We're looking forward to an interesting discussion, so join us as we continue our journey of tearing down silos and building bridges on Security and Compliance Weekly.
This is a Security Weekly production. And now, it's the show that bridges the requirements of regulations, compliance, and privacy with those of security. Your trusted source for complying with various mandates, building effective programs, and current compliance news. It's time for Security and Compliance Weekly.
Welcome to episode 78 of Security and Compliance Weekly, recorded on June 29th, 2021. I'm your host, Mr. Jeff Mann, and with me today in studio is my co-host, Scott Lyons. It was an adventure getting here, but we're here.
Woo, man, it was a long drive. I can't believe we got over the bridge that fast going through New York, like grease lightning.
It was amazing and something I'm going to write home to, or I'll just tell them when I get home. Remotely, we are joined by Mr. Josh Marpet and Mr. Liam Downward. Gentlemen, welcome.
Pleasure as always.
I'd like to pause for just a moment and say I'm in G-Unit Studios. I'm in studio. And
How long has it been, Jeff? How long has it been?
I had to look it up, and of course, you can find everything on the internet. I found a convenient little app. It's been 475 days since I've been in this studio. 475 days. And that hopefully will be a record that never is broken again. So it's good to be back. The feelings of being back here, which is like, this place is like a second home to me. It's very special to be here. But enough of that. Not only is it special to be here, but there's the humidor that I haven't been to in 475 days. Anyway, have a few announcements before we jump into things. Security Weekly Unlocked will be held in person this December 5th through 8th at the Hilton Lake Buena Vista. That's in Florida, of course. Our call for presentation deadline has been extended through July 5th at 11:59 p.m. So come speak at Security Weekly Unlocked. You can sign up, apply by going to securityweekly.com/unlocked. Submit your presentation request. Also, on July 14th, we will have a demo cast. I guess we've coined a new word here at the studio. It'll be 11 a.m. Eastern Time, and you can learn how to reveal and protect your entire attack surface. Then join us July... Crap, was that 15th or 16th?
15th.
It was 15th? Yeah. Thank you. Teleprompter learning curve here. On that, you can learn how learn a thoughtful approach to SASE and how that can improve your security and enable your scalability. And then on July 22nd, we will have a technical training, again, 11 a.m. Eastern Time. Learn how guided SaaS NDR enables rapid response. Sign up for all of those by going to securityweekly.com/webcasts. Also, of course, if you've missed any of our previously recorded webcasts or technical trainings, you can find them in our archive, which is at securityweekly.com on demand. All right, enough of that. Our guest today, Steve Lenderman. He's considered to be an industry expert on whatever I said in the intro, but deep fakes, fraud, all that kind of stuff. He's got over 20 years of experience investigating financial crimes for various banks and financial institutions. He currently works for a company called ADP, which raise your hand if you get your paycheck through ADP. In fact, 6 out of 10 Americans get their paycheck through ADP. So, Steve, whatever else goes on today, thank you that we all get paid. Steve, welcome to Security and Compliance Weekly.
Well, thanks for having me. It's a pleasure. It's been an entertainment event so far. Can't wait to get into things and have some good discussions.
Well, we're looking forward to it. Tell us a little bit about yourself, your background, what you've been doing over these last 20, 25 years, and how you got to where you are today. Please.
Absolutely. So yeah, as you mentioned, I've been in the financial sector for about 20, 22 years now, all in the fraud space. Began like anybody does in Delaware in the credit card space, right? Everybody mails their bill to 19808 and 801, which is Wilmington, Delaware. So like anybody, I started in the credit card space, spent about 15 or 16 years with multiple banks, starting out, in the chargebacks area and working my way up all the way through fraud operations, et cetera. Was able to get through the recession, which was fantastic, back in 2008. And then we decided to get into some different things in credit cards and got into kind of the fintech space, right? Back then, it wasn't a niche term. It was like literally a brand new term. Like, what is a fintech, right? Using the data and technology and basically getting out of old school banking. From there, ended up into PayPal through an acquisition. Spent several years at PayPal working in their small business lending area. And so we are able to basically do unsecured lending for small businesses using lots of data science, risk modeling, and some fraud prevention, obviously, which is where I came in. And then the last 3 years, I've been with ADP, or Automatic Data Processing. So that's, as you mentioned, is the payroll company. And when I first got the phone call about the opportunity, it was kind of like, what do you mean fraud and payroll? Like, you just submit payroll, don't you? Like, how hard is that? And why is there fraud? Little did I know that there's a significant amount of fraud taking place in the payroll space. And like anything, whenever there's lots of money being moved around, there's lots of bad guys wanting to get their hands on that money being moved around. So I've been here for 3 years now, just over 3 years, and working on building essentially a fraud risk strategy for them and building out some automation, leveraging numerous external data sources, internal data sources to basically try to onboard new clients relatively quickly and keep the bad guys at the doorstep or further away. During the course of all this, I became deeply involved in, as we mentioned, synthetic identities, and now into the deepfake space as well. So synthetic identities in the fraud space is kind of a new hot term, but like anything else, if you've been in this space, it's been around for almost 15 years. It's nothing new. So we've been doing that for a while. I currently chair our Bust Out Synthetic Identity Working Group, which has about 650 investigators and from financial sector, law enforcement, et cetera. We share lots of great intel across the industry. That industry is banking, home, auto, mortgage, you name it. It's in that space, travel, everywhere. And then obviously, getting the deep fake. So it's been a fun journey, one that I think I'm about halfway through. And I'm looking forward to the next 20 years. And at some point in time, to hanging out and having a cigar and maybe a nice glass of apple juice on a Tuesday afternoon.
It's definitely something to look forward to. So just to clarify, synthetic identities and deepfakes, two different things?
They're similar. But there's also some differences, right? And so synthetic identities is the creation of a financial identity or a digital identity using data identifiers. So for most of us as humans, right, we're born with a name, a date of birth, a social address, et cetera, right? And these things are all very static things. We once you get them, right? You don't change your date of birth, you don't change your social security number, et cetera. And so synthetic identities have been around for a while. And what we've seen is actually fraudsters using either completely fictitious information, like creating a name, creating a date of birth, creating a social, et cetera, right? Aggregating all that data together and then flooding that data into the data aggregators. The other way to do this is you use bits and pieces of information. So maybe you use deceased information, right? A combination of a deceased name, a deceased social, but obviously you want to change date of birth because they're dead, right? So you need to get a new date of birth, new address, et cetera. But the reality is here, whatever you're doing, whether it's the completely fictitious using completely brand new stuff, or whether you're mixing data together, which sometimes people call it Frankenstein synthetic identity. The idea is taking this data and then you aggregate it into the aggregators. Right? The aggregators are the credit bureaus, the Googles, you name it, right? The large LexisNexis and Thomson Reuters, et cetera. And you basically flood the aggregators with this data. And what you essentially do is you're building your digital identity, right? As we all do right now, our identities are probably mostly digital, right? My parents, my grandparents was all documentation, right? My kid who's 19 now, whose identity is completely digital, right? Doesn't know what a checkbook looks like or how to use it, right? It's all digital stuff. So that's kind of what a synthetic identity is. Now, with a synthetic identity, you would try to validate your identity in person by using, good old-fashioned fake IDs, right? For those of us near the Philadelphia area, you go to South Street and you pay $25, get a fake ID, and go to the bars. Well, now you buy the identities on, deeper dark web places, or you go to South Street, or you go to Reddit or Craigslist, wherever you want to, and get your identity, right? Now is the idea, like, I prove who I am because I have a driver's license, and that driver's license passes all the KYC standards for most banks. And so that's why it's important for synthetic identity to have some kind of actual physical identification tool. But with the rise of COVID, right, and the rise of online banking, et cetera, people just don't go to banks. And the idea is like, take a picture of your driver's license, et cetera. It was pretty easy to fake that stuff, using, PDF or whatever you want to use. You can create this stuff. So then fraud prevention tools got faster, right, and better. Like, take a picture of a selfie, take a video of yourself, which has kind of got into the point where deep fakes kind of cross in now in the financial sector. Is that before they were used primarily for nation state attacks or political, endeavors, right? But now they're being used to basically pass authentication. So we're seeing a creation of a synthetic identity, and then legitimately like an actual, like, human, essentially a deep fake of like you or I talking on the screen here. So they would interact with somebody who's trying to authenticate them as a legitimate individual to give them, let's say, a PPP loan, right? Or a car loan or whatever it might be, to prove who you say you are by going to a video, because you can't fake video, right? Oh, yes, you can. That's where deep fakes come into play.
Right. Okay. Well, I appreciate that brief education. I think all of us are learning here today, co-hosts and listeners alike. I would be remiss if I didn't mention to you at this point that I've been involved in the credit card space for, going 17, 18 years now, mostly within the PCI world. And, you kept mentioning credit cards. I've been to Wilmington. I've had clients in and around there, dating all the way back to 2004. It's interesting, though, because PCI is mostly concerned about the theft of credit card data, implied that somebody would use it someday for, to commit fraud. But that's not really a primary interest of PCI, other than, let's try not to have the data stolen in the first place. We are a show that focuses on security and compliance. This is the little corner that they stuck me in because they got tired of hearing PCI on the main show, I think. We do like to start our shows officially with what we call the hot seat question for all of our guests. And it's strictly to help us to get to know you a little bit and get a little bit of your perspective, based on your experience and what you're working on. So our hot seat question is simply, where do you fall on what we like to call the security versus compliance continuum?
Yeah, so our big problem, for example, in synthetic identity is a significant compliance issue, because the bank's big question here is you have to action the accounts, right? And you have to action them in a derogatory manner. So you're either going to close the account, you're going to restrict the account, or you have to let the account go, right? And so the big issue, with FCRA, Fair Credit Reporting Act, right, and UDEP, Unfair Deceptive Acts, is that the banks are really touchy now on just closing accounts, right? So my biggest challenge in the credit card space, 10 years ago, and still is a challenge in today's space, is for the banks to know you have this synthetic identity, but you can't action it because there's this risk that you could be sued, right? Or there's going to be a class action suit against you, or there's discrimination, et cetera. My argument to all of our privacy and legal and et cetera, was like, you can't be sued by someone who doesn't exist, right? They're completely digital. Now, the scary part to this is that we did see a version of this through, I mentioned FCRA, or Fair Credit Reporting Act. There's a section of that called the 605B. And 605B essentially allows legitimate customers the opportunities to essentially clean their credit, right? If there's errors in their credit file from an old lien, or a doctor's office put a derogatory mark on their credit bureau or whatever, but the consumers have the ability to dispute those actions on their bureau, whether it's an inquiry or an actual trade line. So what these guys have figured out in the synthetic spaces is they're creating these identities in mass. They will also go back and clean these synthetic identities using a 605B. So you write to the bank. The bank has 30 days to handle the claim, right? And the reality is they're using a compliance tool, right, to essentially was designed to help a consumer, is now being used to help the bad guys. And so the banks get really scared. It's like, oh, they're not going to sue us. Well, they just sent us a letter. They just sent us a 605B request. And I'm like, that's the same 605B request, that it's the exact same format. They use the exact same proof of claim, which is a falsified police report, the exact same police report number, reporting officer, the exact same narrative, et cetera, right? So that's where the compliance kind of thing comes in, is the banks can't really act on these without like extraordinary proof. So until they can act on them, they're at risk. They're at risk of taking huge losses on these things, because they can have $20,000, $30,000 credit lines because they're created identities. And I can create my synthetic identity and nurture, and we call pollinate that synthetic identity to have like an 820 or 830 FICO score. And as we all know, if you got 820, 830 FICOs, you're qualifying for $40,000 credit lines easily. And that's easy money for the bad guys.
Right. Liam, you had a question?
Yeah, I do. So the question I have is, with everything that's going on, how do you take it into, like, maybe I might be saying this wrong, but FTC has the red flag, and then you've got fair warning. So how does that come in there from a fraud and compliance, when you can have around Social Security numbers for regular businesses that need to implement those type of scenarios for protecting themselves against both internal fraud as well as from external bad actors?
Yeah. So as anything, the federal government does a great job trying to keep up with things, but we all know that they're at least a decade behind what's really going on in the world, right? As far as regulatory issues.
Define
the
great then.
Yeah. So identity theft red flags, I mean, that was in the 90s. I mean, when everybody was buying paper shredders, right? Everybody was freaking out, right? The red flags it doesn't really help us much anymore. So we're looking for our own red flags, and the industry is really had to do this on their own, right? And through that, some of that is through collaboration and consortium type engagements to identify, what we're looking at, right? So mostly PII at this point, your name, date of birth, and social. For us is just the check boxes for KYC, right? Know your customer. But we don't use any of that anymore to do any authentication, because it's essentially worthless. It doesn't mean anything to anybody. One of the examples would be, if you're looking at your traditional trade line file, I'll use myself for example, right? When I'm in trouble, my full name is Steven with a PH. But I go by Steve, right? So there's two variations of my name, and then there's kind of people spelled it Steven, right? And I get Stephan, Phen. People have fat figure my date of birth, my social. What's really happening there is technically I'm creating other synthetic identities, right? They all report under my trade line. And so to try to use any of that information off your credit bureaus and traditional data aggregators doesn't really help us. So that's where we're looking at new technologies to kind of combat synthetic identities and to combat what we're seeing in deepfakes here, right? Looking at basically device information type stuff and digital identifiers. No more looking at static identifiers.
So then regulated industries, such as online gaming, casinos, and other things that use KYC, they're utilizing, a process that like OFAC and stuff that banking could be utilizing. But again, you're saying that is kind of like old technology and can be easily kind of, you can pass the scratch and sniff test basically and move on to the next stage and go for stuff. But how do we then take it to the next level that regulated industries, whether that's healthcare, whether that's insurance and so forth, can actually then have access to this technology? Or do they need to look internally for themselves to start looking at things and using a human element around that rather than automated with or augmented with AI?
Yeah. Great point. So what we're seeing, like anything else, is the financial sector is typically hit hard first, right? We've been hit hard for about 10 to 12 years, really seeing stuff through. But if I ask any industry, so, if they're in healthcare, whether they're in gaming, whether they're in travel and entertainment, et cetera, right? You ask them, are you guys seeing synthetic identities? And their answer is like, no. I'm like, you are, you just don't know it yet. You haven't looked, right? And that's the big difference, right? It's a combination of You said using machine learning, AI, and some risk modeling scores to develop, what's your secret sauce to find things within your books and your portfolios. And then from there, unfortunately, I hate to say it, right? Technology and automation will build you the haystack. Unfortunately, right now, you have to have the farmer with the pitchfork trying to find the needles in the haystack.
Well, that's easy. That's easy. Just burn the haystack to the ground and bang, there's your needle.
That's one way to do it.
So with everything that you know, Steve, okay, with everything that you know and everything that you've accumulated as far as industry knowledge of how all of this works, break it down for us in layman's terms. What keeps you up at night?
What keeps me up at night right now is legitimately what I call synthetic entities, which is the creation of synthetic businesses, which we've all known as called shell companies before. Mm-hmm. And these shell companies were created in the past really for, money laundering, drug cartels, or embezzling of money, et cetera, right? They weren't really used to make money. They were used to pass money through. So kind of, again, an AML compliance issue. What we're seeing a shift in right now is the fraud is changing from the individual consumer space to the commercial and business space. And why that scares the you-know-what out of me is because, even with great credit and history, I would qualify for again, a $25, $30, $40, $50,000 maybe credit card, right? Maybe a small loan, whatever it might be. That's the individual space. If you own a small business or a SMB, a small, medium-sized business, you're going to qualify for like a Capital One Spark card or a Chase Sapphire card, or it might be. Minimally, you're a $100,000 credit line. If you want to apply for a small business loan, you're talking millions of dollars, right? You're talking for PPP loans, millions of dollars, right? The exposure.
Steve, wait a second. The PPP loans had, less qualification, less rigorous due diligence. Agreed. But on the whole, SBA loans require significant amounts of preparation of tax records of the principals, as well as the business. They require a lot of documentation, a lot of due diligence to get that kind of money. Are you saying it's just as easy or easier, or
Yeah, so a traditional SBA loan, as you mentioned, is what I call a regulatory or financial colonoscopy. It takes months to get
he's technically speaking, he's not wrong. That's the problem.
It's just a very good way of illustrating it. Yes, agreed.
Yeah, it takes months, and you said you have to have paperwork, its favorite color, shoe size, documentation of your dog. It's a nightmare, right? And it's all for $20,000 because that's all the SBA used to give out, right? Right. The difference now is, with little Corona COVID thing, right? PPP came out, right? And so all the SBA did, because they couldn't handle the volume, right? They pushed all that volume to the banks to do the loan originations. And there were several controls for compliance in place. But the volume was too much. The need to get the money to the businesses was significant. The pressure from the public was immense. And traditional banks just couldn't keep up with it, like your B of A's or Capital Ones, et cetera. Again, nothing against those banks, right? But just couldn't handle the volume. So when traditional banks can't handle those things, what ends up happening? They go to fintechs, right? Who are efficient, use data, can do things, really quickly and cheaply. And so that's what you saw happen in the PPP space, for example. I want to get back to that a little bit because it's a whole nother conversation, but you had PPP loans being processed by some fintechs. And if you go to the SBA site, you can see the top 10 issuers of SBA loans. And number 3 through number 9 are all fintechs that prior to COVID were not SBA loan providers. And when I did the math, they were doing an SBA PPP loan every 32 seconds.
Wow.
Yep. There were a lot of companies that we heard of that received really big PPP loans that should not have gotten them.
Yep.
And other companies, smalls and mediums, that the calculations were wrong from the banks. Yep. Josh, when we were dealing with this in Red Lion, we actually experienced that firsthand with Bank of America. Yeah. So let's shift gears. So we're talking about deepfakes and we're talking about how to see all of this. I remember there was some Netflix show talking about number theory and how to use number theory to be able to show deep fakes. Is that it? Do you know where I'm headed with that, Steve?
Yeah, a little bit. So
can you talk about
my disclaimer? Yeah, my disclaimer here is, listen, I'm not a tech guy, a coder, a cyber guy. I'm more I call the grunt, right? I'm the guy in the trenches, trying to figure things out. So when I'm seeing the deep fakes is from an operational perspective and trying to obviously determine, if they are deep fakes, right? And then protect our clients from them, because that's my biggest concern. One is protecting ADP, our executives from receiving, but also we pay, as mentioned, 6 in 10 Americans. We have 700,000 small businesses, and we pay 80% of the Fortune 500s. All right. So we are a significant target, and our clients are significant targets for things such as deep fakes. All right. So the reality for us, the most important thing for us is education. As much as I want to rely on technology and trying to catch it from a technology perspective and writing code against it, it's really about, unfortunately, the human firewall when it comes to this stuff. And that's the scary part.
Let's take this another level. I mean, you mentioned synthetic entities, not synthetic identities, but synthetic entities, the companies that are faked. Yep. I mean, a real issue here is that when you're talking about supply chains, and we talk about supply chain risk all the time, you're talking about risk in terms of credit granting and loan granting, but I mean, it's the same idea. Before we give trust into a company, into an entity, to handle our information, to deal with our whatevers, due diligence on that has got to be pretty good. How are there any tips or tricks or techniques that you can think of for doing due diligence to make sure that a company who's giving you a proposal, we're going to do XYZ for you, we're going to sell you this, we're going to buy you that, whatever, is not a synthetic entity?
Well, before we jump into that, because that's, ultimately we want to get to, what can we do about it, and what can we do as professionals, either in the security and the compliance space. That's sort of the second half of the show, Josh.
All right, I'm sorry.
No problem. I wanted to ask though, Steve. We talked a little bit on our prep call about some of the things that have emerged just in the last year and a half, or even just the last couple months. Could you just, briefly? You might have already answered it somewhat in what's, because it's probably what's keeping you up at night, but can you just frame for us a little bit about, what are some of the things you've been seeing in terms of the application, I guess, of deep fakes?
Yeah, so I was kind of alluding to this earlier, is, we are seeing, this business email compromise, right, which they're calling BECs now, being taken to the next level through the use of deep fakes, because we're all online. Obviously, we're all doing Zooms and WebExes, et cetera, and a lot of information is kind of out there. A lot of our clients who fall victims to these, again, it's about an education to them. And so the reality is, we try to do a post-mortem on how they were attacked, and how they basically moved X amount of dollars, off of their payroll accounts, et cetera. And so the problem that keeps me up at night, in reality, is that we're relying on this virtual technology now. We're eventually getting back to the studio like you guys are, right? But it's the face-to-face Zoom that we've been so comfortable with, that it's been easy to, basically fake, even recorded calls, video calls, to send to executives. And then the idea being is, as well, is that so much of our data is kind of out there, that it's easy for, threat actors to basically scrape that off surface web and develop attacks, that are, again, towards BECs. The old-fashioned method was the old-fashioned phishing emails, right? You would just get a bunch of emails and throw a bunch of stuff against the wall and see who responded. And then they got more complex with spear phishing, right? Now they actually have targets, and they know you're a Bank of America customer, right? Or they know you have a PayPal account, et cetera. Well, now this is what's happening with BECs, is that before it was just, let's throw a bunch of stuff against the wall and see what idiot replies. But now what we're getting is very targeted. They're doing intel and research. They're looking at LinkedIn's, they're looking at other professional certifications, et cetera, gathering their data, and they're attacking targets specifically. And they have the ability to pull data down, and really social engineer the person, even though they're not talking to them. Right? They know more about them than the person themselves, essentially. Oh, I remember I met you last year at the Black Hat. We had dinner at the Mandalay Bay, whatever it might be, because you posted that on your LinkedIn, or you posted that somewhere in, who knows where, right? The bad guys know that stuff. That's what's really scaring us right now and a focus right now from that perspective is trying to give our clients be smart and our employees be smart too.
Well, anytime that you can sort of tackle layer 8, which is the human element, and then, layer 9 after that, it's always going to come back to be a boon for whatever business it's in. The four of us, and Steve, I'm not including you in this, the four of us holistically believe that, and you guys can totally tell me I'm wrong.
You're wrong.
Fair opinion. The four of us
I should hear you first.
The four of us believe holistically that security should be brought down from the business to the family to try to protect everybody in the stack. If you have a business like small, medium, it's not just the people that are working for you that are loyal because you're paying them. It's also their family and their family's family and all of that connective tissue that supports that individual working for the business. So we believe that security awareness training and trying to deal with the human element should be taken from the corporation down to the family and down to the child ultimately, and the child's child at that, at some point. Unfortunately, we as an industry have been banging this drum for years and years and years and years, and everybody's been able to go tone deaf on that specific fact right there. Bring it from the corporation down to the family and protect the family, which protects the corporation in turn. Jeff?
Well, I wanted to bring up first, I don't disagree with Scott, but I do want to sort of out Scott a little bit. He's addicted to this relatively new technology called, and I can never think of the name, your voice only thing.
Oh, you're talking about Clubhouse.
So there's this thing called Clubhouse, and driving up yesterday we were listening to Clubhouse, and there was a group that was talking about all that's wrong with the world. They were supposedly talking about infrastructure, but they really didn't get around to that. But they were talking sort of generically about the problems that have plagued InfoSec and companies for the last 25, 30 years since we started doing this whole internet thing. But what they failed to talk about, and I'm interested in getting your perspective as it applies to your world. Again, we're coming from it from more the data protection, confidentiality kind of focus, and I suspect that you're beyond that in some degree. But in the old days, 20, 25 years ago, 30 years ago, the idea of what the bad guys were going to do was steal your data. The early days of when PCI, what made PCI become a thing was credit cards were being stolen and then used to commit fraud. But the paradigm has really changed, in my opinion, over the last couple of years, where the bad guys no longer need to go figure out where they can find a target, and usually it's a target of opportunity. They're not usually specifically targeting companies, although they do that, and they're trying to get in and get out and steal as much data as they can. Now they kind of don't have to. Now and I don't want to diverge into a ransomware discussion, but the bad guys have figured out how to monetize, make money by not stealing the data, by limiting the access to the availability of data. I'm curious as to whether, in your world, where you're coming from and what you're seeing, are you seeing similar analogous types of paradigm shifts in what the bad guys are doing? Obviously the tactics are changing, but the end game, I guess, is that changing, or is that relatively static in your world?
No, it's definitely changing, and it's changing because what we have going on is, instead of the threat actors coming after us to steal the data or to network intrusion, et cetera, the problem now is that most of the time when we have an incident, that incident is caused by the individual basically giving away the keys to the castle, right?
Right.
So when we look at a particular, like a deep fake that's an attack against a C-level individual, just like we're doing here, right? We're recording video and audio, right? So to create these deep fakes, you need to get the sample set, essentially, right? And then you use machine learning and AI and supercomputing, all the fancy stuff.
We gotta stop the show if we're no.
Yeah. So you have all this data, right? So now you have audio, and now you have video, And then you have all the open source information on LinkedIn and wherever else, trade shows or wherever podcasts or articles people are writing. And it's all being given away for free. Right. And so the biggest thing we have trouble with right now is, not just convincing our C-level folks, but even the second and third level down, and our clients, our major clients, employees, don't, like, every time you put a speech out, like right now, like we've all been virtual, right? We're doing presentations virtually, and most of these are recorded in some way, shape, or form, right? But every time you provide a video sample, you're providing a bad guy intel they need to make a deep fake of you, all right? And that's the problem, is that how do you limit that? Once it goes digital, you can never get it back, and that's the problem. We are seeing way too much information being put out there, so much so that we actually have a bunch of fake LinkedIn personas that are created to look as targets. Right? We've basically created fish. Right? Great names, payroll, C-level people, and we try to get them targets to attack, videos, etc. Right? Everybody puts podcasts or videos in your LinkedIn's. Again, you're giving them everything they need to build a deep fake about you.
It's funny because in that chat room, that Jeff, that you were talking about, Clubhouse, it's really funny to watch a mind reboot when you tell them that, hey, Facebook isn't free. You are the product.
Right. But what I'm hearing, and we're going to take a break here in a second, but what I'm hearing you say, and sort of the conclusion that popped into my head yesterday when I was listening to this conversation, is for all the things that we as an industry have been doing on the security side, on the fraud prevention side, for all the advances, it's effectively that much easier today for the bad guys to do what they're doing. Agree, disagree?
Absolutely agree. Before, we try to protect the consumer, and now the consumer just gives it all away.
Right.
They don't protect themselves. Unfortunately, they are their own worst enemy.
Right.
And that's a challenge.
All right. Well, let's take a break for a moment. We'll come back, and hopefully we'll talk about some practical things we can do to try to help prevent and protect and make this all go away. So be right back.